Good afternoon, everyone. First of all, I'd like to thank the McCleary brothers, Matt, for introducing us. Thank you, Matt, and Mike for clearing the stage. I'm Rob Lushin. I'm a member of the Transportation Industry Group of Reed Smith. And if you're not familiar with our law firm, we're an international firm with 31 offices around the world and close to 2,000 attorneys serving many industries, but are very, very proud of our prominence and focus in the shipping, offshore, and aviation industries, and are really happy to be here once again with the Marine Money team and a great panel that we have this afternoon to top things off. To recap what we learned this week, and since our panel last year, while interest rates and inflation appear to be stabilizing, armed conflicts around the world continue, notably the war in Ukraine, unrest in the Middle East, with vessel values and charter rates continuing to strengthen. Overall, it's been a good year for shipping, and we've had a great conference this week. Our topic today is a high-level view of the U.S. capital markets for shipping and how the listed companies and investors can reap the benefits of participating in these markets. And we've assembled a really nice panel here today. Thank you to the Marine Money team for that. Let me introduce them, maybe coming from the end down. Paul Leand, Managing Director and CEO of AMA Capital Partners. Paul's been an icon in the international ship finance industry for as long as I can remember, having advised shipping companies, funds, investors, banks, including funds that Paul and his team have created and structured over time. And Paul sits on the board of directors of a number of high-profile U.S.-listed shipping companies and has a deep knowledge of the inner workings of both the industry and the companies. Ned Sherwood, who's sitting to Paul's right, is the manager of the Sherwood family office and co-founder of the ZS Fund. Ned actively invests in securities of the U.S.-listed shipping companies, and we're very fortunate to have him here with us to share his view. Next, Jay Mintzmeyer, the founder and president of Value Investors Edge, which provides research on publicly traded shipping and energy companies, including tanker, container, dry bulk, and offshore companies. And he's very, I think he's very focused on eliciting deep value from those type of investments. And finally, Ed Finley Richardson, CIO and a social media influencer with Contango Research. Ed is a shipping company equity investor across the various shipping sectors with an established social media following and has valuable insights for us from the investor perspective as well. So it's no secret that access to the U.S. capital markets has significant benefits to the public shipping companies by providing them with unparalleled access to capital, enhanced liquidity, as well as making shipping investments widely available to both institutional and retail investors. And to our benefit, the transparency of the U.S.-listed companies takes the mystery out of shipping to the public, demonstrating our collective commitment to a green future for the world and through decarbonization and other environmental protection initiatives. So as we've heard from some of the experts over the course of the conference, purchase and sale markets are strong in just about all of the shipping sectors. New building orders are strengthening, particularly in the container shipping market, products, tankers, et cetera. And we've heard about technical modifications and engine retrofits that will help in the decarbonization effort. The U.S. capital markets are open to shipping companies, but do they need or want the money in light of current valuations? So coming back down to how the public markets work for the shipping companies, it appears that all the U.S.-listed shipping companies, whether on New York Stock Exchange or NASDAQ, trade at a discount to NAV with very minor exceptions. And I'd like to ask each of our panelists their view on the symptoms and the cure for that disparity. So why don't we start with Ned, and perhaps you can lead us in the NAV discussion.
Sure. I think there's valid reasons why most shipping companies are trading below NAV, and they're not because of the current environment, which if they're more in terms of governance and questionable procedures such as having private ship management companies allied with public entities that don't really disclose the true remuneration between the two entities, and just possibly general governance issues in that you do have a lot of freewheeling entrepreneurs and family companies in the industry, and they don't necessarily seem to care about net asset value of the publicly traded entity. They seem to care about how much cash they can get one way or another. I think if companies, number one, if there are mergers and companies in the industry get bigger and governance gets better, we will see improved capital markets and companies starting to trade above NAV. But until then, there's a lot of questions, and you got to know your partner, and a lot of these people may not exactly be on your side.
Paul, perhaps you have a view on NAV as well.
Yeah, look, I think I think that's largely right. I think it's a little more nuanced than that, or more complicated than that, because I think there are two parts to it. There's clearly boards matter, governance matters, alignment matters, and I think that's a general issue in shipping overall. But I think also your shareholding base matters. We at AMA have looked at this over the years many times, and I will tell you, if you were to look at publicly traded companies that are controlled by strategics versus publicly traded companies that are widely held or controlled by financials, there's a definite difference between how those companies trade and how they're valued in the market. And the real reason is because what we have found over time, whether it's a strategic who's a good strategic or a bad strategic, almost doesn't matter, because the simple reality is that the strategic's in the business to be in the business, whereas the financial investor is in the business to make money. The one exception to that we have found over the rules have been John Frederickson's companies, and I think the simple reality is that, and I've been on John's boards for 15 years, or have spent about 15 years on John's boards, is because John is essentially a financial investor. He aligns himself with the shareholders. That's how he makes his money. He doesn't have any other pockets to do it, and so if the company does well, John does well, and so we see that as a differentiation in the overall theme. But I'd say that is the biggest thing that we have found over the years.
Why don't we have Jay comment?
Oh man, time to throw some grenades. I think it's a great question. I do take a little bit of an issue with saying none of the companies trade above NAV. I mean, if we go back about a month from now, we had a little bit of a pullback in June. If we go back to the end of May, the valuations in shipping were the highest I've seen in my career, and more than half of the firms that we cover traded at what I would say is a pretty heavily valued level. But there are sort of two buckets. There's a barbell sort of set up in this market where you have half the companies that have good corporate governance, good dividend policies, clear structures, and they trade at strong valuations in a strong market like they should. And then you have the other half of the companies that are special, ... situations, right? And it's not that complex. The governance is a wreck. There's no clear dividend policy. A lot of these companies don't communicate with shareholders. So we have a thesis, and I think Ned probably shares some of this. I don't want to speak too much for Ned, but we have a thesis that there are some companies that fall into that second barbell, that second side, where they are willing to perhaps make some changes. Are they going to transform overnight? No. Well, let's be pragmatic here. But if they do some changes, like update their dividend policies, add an independent director, do certain things like this, consider share repurchases, there's a lot of money to still be made in that sort of catch-up trade in that second barbell.
Well, let me just follow up. So how important is messaging from the companies? Many public companies have very strong investor relations folks and departments who get the message out. Others are less rigorous with their investor relations and maybe are reluctant to share the depth and volume of information with the public. How much do the companies that are less interactive, how much do they get dinged for that on NAV?
Yeah, that's absolutely a factor. And the same sort of companies that trade at premium valuations, that we had an interesting panel that just concluded, the analyst panel, and there's a lot of excitement about a couple names on there. One of them was Frontline. And I like Lars, so I won't say anything negative, but I will say that the positive side of that is they traded a premium valuation not just because of the backstop that we've talked about. Lars is very active, Lars is very open, Lars communicates very well. Okeanis Eco-Tankers, which recently migrated to the US markets as well, trades at a very strong valuation. Aristides is very open with the investors. He participates in a lot of things. Oisin, who I think just unfortunately is not in the room with us to hear all the good things I'm about to say, but he has been at the forefront of shareholder communications. There's several other management teams. I don't want to leave them all out, but I also don't have 10 minutes to say all the good things about them. But the ones that communicate certainly make a difference. And some of those communicators might be with companies that necessarily don't have A+ corporate governance, but they're good communicators and they trade above NAV.
Ed, any thoughts on this topic from your seat?
Well, I think some of the tactical approaches I would have taken to address the question have already been used, so I'll try a different tack. There are two things I would mention which haven't been mentioned yet, and I guess I would just add them to what has been already said, which I think, everything which was said was valid and germane. But I think that the unspoken truth about the reason why some of the John Frederickson companies trade at such a premium is because he is the Leviathan. He is the person who's going to make sure that if someone wants to change the way the companies are run, they're going to leave exit stage left. And we've seen it happen many times. He doesn't hesitate to get rid of executives, even some who, for practical purposes, as far as people can tell from the outside, have been doing a fair job. But I think that he is a large share owner, so it's as if all of us as investors, minority investors, have an advocate in him. And because we can trust, not that he is a trustworthy person, but that he will look out for his own interests, and his own interests happen to be aligned with ours. So it's a subtle distinction, but it's an important one, because it's the reality of what makes those companies so strong, and because he's kept that culture among his companies for so long, that develops a track record, which means you can depend on him to jettison people if he doesn't like them. And we know what he wants, and what he wants is aligned with us. That's the first thing. The second thing is a little more subtle point, which has to do with what NAV actually is and what it communicates and what it doesn't. It's ironic that we always talk about shipping companies trading at a discount to NAV, but the NAV is constantly moving, right? Because it's calculated based on the earnings capacity of the vessels. Usually has to do with the period charters, and those are moving. Those are moving all the time. In fact, as investors, we track that every day. We want to see where the period rates are going, because that gives us an indication for how much someone will pay for a ship to cash in on those earnings, right? The problem with it is shipping companies will trade at 2 times earnings, 3 times earnings, 4 times earnings, and there have been some analysts who have argued in favor of using earnings and multiples as a basis of valuing companies and no longer using NAV. The problem is we have very little visibility on earnings far out into the future. Even if we're in a bull market, what is the likelihood that that bull market will last more than 3 years or 4 years? Well, if we look historically, its likelihood is very low. So why would you give it a 20 times earnings? You'd be crazy to.
Well, wouldn't you say, though, that the shipping cycles have really started to get a little more elongated as the years progress? So maybe that might have been true 20 or 25 years ago, but aren't we really seeing an elongation? So, for example, when we had the recession, and where many of the shipping sectors were, trading very poorly and charter rates were low, almost uniformly, that seemed to have lasted much longer than a lot of the analysts had predicted at that time when they were extrapolating from prior periods. So are we seeing a more elongated cycle, or do you feel that we're returning back to a more rational, shorter cycle?
That's a tricky one. Certainly, the further you go back in history, there's a lot more short cycle volatility type things happening. You see, I was speaking to an analyst at Posidonia a couple of weeks ago, and he told me that in the 70s, there were vessels that were 10 years old that were being scrapped. Because as soon as people lost their optimism, they wouldn't hesitate to do it.
They were coming out of the yard and being scrapped.
Yeah.
I mean, literally.
Yeah, so I'm skeptical we'll come to that paradigm, but the thing is, it's very difficult to compare because we have a supply-driven cycle right now. So no one in their right mind would scrap anything. I mean, in all the reports we have forecasts for scrapping, and there's always a little bit of scrapping which is forecast, but everyone knows that nothing's going to be scrapped, and nothing has been scrapped. Because as long as you can make any money with a ship, especially someone with parallel trade with Iran, that vessel is going to be very valuable to them. So anyway, we'll leave time for the others.
Okay, I don't know if anyone has any more thoughts on that topic. I would like to switch to investor perception of the shipping industry generally and how that affects the investability in the public companies. So maybe, Paul, you can kick us off with this one.
Yeah, look, I obviously, I think that character is important in shipping, and I think that it's probably the most missed aspect of people who are looking to invest capital in this market and to buy stocks. I think that to scrape a vessel's value NAV calculation and post it up and say, hey, this company's trading at 50% of NAV and therefore it's a great investment to buy it, is probably the most rudimentary analysis you can do in shipping. We used to do it when I was 20 years old doing credit analysis at the bank. The problem is that the people matter and the alignment matters in terms of this stuff, and unless you understand how the management teams and how the boards are going to approach the markets and what's important to them, and making sure that those things are actually important to the shareholders as well, you can buy all the stocks you want at 30% of NAV, and they're never going to do any better, and they're never going to trade any better. And the definition of insanity is to do the same thing over and over again and expect a different answer. And I think, unfortunately, that's what we see mostly in terms of the analysis that you get in shipping. It's so NAV driven. It is so absent of the understanding of what's going on in the boardroom and how they are thinking about the markets and how they're thinking about returning capital and returning investments to shareholders. That until you start to address that, frankly, I don't think you're really understanding how to invest in this sector.
Yeah, I'd say coming out of private equity, where I concentrated for 40 years on family-held companies, I think it's very important to know what the objectives are of the leaders, and in many cases, majority shareholders. In shipping, there's a lot of companies that came out of families, and you have to, I don't really look at NAV, I look at cash. And basically, if you have a management such as Starbulk, where they enumerate a very clear policy of we're going to keep leverage at a certain moderate rate so that given the cyclicality of the industry, we're not going to get caught short and risk insolvency. We're going to keep X million dollars per ship as a equity cushion on top of that, and then we're going to give you your cash beyond that. We're just going to flow the cash to you. Cash is always worth at least book value. It's like if it's in your pocket. If it's in the stock and the stock is trading at 50 cents of book value and the management's saying, hey, I'd like to keep that cash, they're keeping the cash and devaluing your cash that should be in your pocket. So I agree with you. You have to understand management. And management that has clear policies that benefit shareholders will do well.
Yeah.
NAV is a metric just like anything else, and you have to think about what the market is saying about a company that trades at 50% NAV. right? Because if you just think about it in a conceptual nature, the price of the ships, you put the fleet together, and then you add a little bit of a chartering desk, you add a little bit of the expertise of management, the capital allocation. You would think even if that adds just 5, 10, 15% of premium, right? You and I, could buy a ship tomorrow, but we wouldn't have the chartering desk of Frontline or a Scorpio, right? Or an Eagle Bulk before they were taken over doing that logistics side. So you would think at a bare minimum, a normal trustworthy shipping company should trade maybe 110, 120% NAV, right? The value of the fleet plus the management. So when a company trades at 50% NAV, the market is saying this company is such a turd that the management is so misaligned that they're going to incinerate 50% of your capital. And I know Ned will have some thoughts later in the panel as well, but I know Ned is invested in a couple companies who trade at 25% or 30% or maybe 40%. You have a couple of them. And the market is saying that this management team is so misaligned or so corrupt or whatever word you want to use that they're going to destroy 75% of the value that they generate.
But that's the problem. That just isn't right. It's not that they destroy value. The problem,
They don't give you the value.
You have to look at where they are in the market and what they do and what their objectives are. If your objective is to be in the shipping business and to be in the sector for the next 20 years, irrespective of what's going on, then why would you trade any better? It doesn't really matter. The objective has to be to run a company on behalf of the shareholders, to return money to the shareholders, not to be in business. At Eagle, we looked at the future and we said, look, we either have to grow or die, right? We're either going to grow this company or our shareholders are better off in somebody else's hands. And so we took that decision and we picked up the phone and we called Star. And that's what you have to do. And if you're not dealing with a company where that's an option, that's your problem and that's why you're at a discount.
Yeah, but I don't think there can be a shipping company that has a long-term family backer that has a long-term perspective that might not trade.
Then don't be public.
But it might not always trade at a 50 or 60 or 70 or 80% discount. I mean, there's differences and there's nuances, but the entire Fredrickson Group somehow falls into some of those categories. I know there's differences and nuances. I don't mean anything negative by that. But NAV is just a metric like anything else, like price to earnings or whatever. It's a screening metric to look for things that are cheap. And if you're going to make money in shipping, and we've made a hell of a lot of money in shipping over the last 9 years, and in the last 3 years, anyone who bought a shipping stock made money. So like, it's not like I can get up and do a victory dance on that one. But we've seen a lot of stuff. I've been following shipping in 13 years, and NAV is a starting point. And you can find situations, like Okeanis Eco Tankers is one of them. And they traded at a massive discount to NAV because the market didn't trust them. The market said this is just like every other different company or different country-backed firm. I'm careful with my words here. But they were trading at such a discount. But if you understood the management and you understood their objectives and you understood what they were going to do, it made a lot of money. There was another company that was spun out of OSG, International Seaways. We followed them since day one. They traded at a 40% discount to NAV for a long time. They traded 30 or 35% below their peer index average because the market didn't trust them. But then Seaways did the right things, and Seaways has delivered enormous returns for us over the years. So yes, NAV isn't the end-all be-all. It's just a screening metric. So I'm not here to say NAV is amazing, but it is a good starting point to see what's out there.
I see Ed's been very careful to try to stay out of this one, but I'm not going to let you off the hook.
I'm enjoying this.
You have anything to add to the debate?
Well, I would say that I have a stylistic bias, which I have shared enough, and I usually don't even have to come out and be explicit with it because anyone who knows me has heard it from me 100 times. But my bias is for quality, and I believe that what management brings to the table is just as important as this deal. And I believe that the companies who traded a premium deserve it, and they will probably trade a lot higher. And I tend to just buy them and hold them, and I don't really care about the rest. And to me, it's a no-brainer. And I don't even know why we talk about it, frankly. On the other hand, there is a different investment style, which says, and it's one that I am interested in intellectually, it's just one that I don't practice because it doesn't suit my temperament. And I'm a big fan of Howard Marks, for example, and he always talks about how the best investments are buying something for less than it's worth, and that discrepancy between what it's worth and the discount is basically where you're going to make your money. And I understand that, but it's not what I do, and I still make money anyway. So why should I buy the cheapest company? It's just, it doesn't really matter in the end because both systems work. But I am in touch with a lot of these companies and the management teams, and I guess what I would say is, it's not the business acumen which is lacking. Some of these guys are really, really clever. who have related party transactions, but they're not credible. And the reason why they're trading at a huge discount is not just the value destruction, it's because, it's ironic, because some of them, they say, well, we've increased the dividend a little bit, and the market didn't recognize it. Or they say, we made this concession, as if just one thing. But it's, one of those things is not enough. Investors aren't stupid. They know that you're just virtue signaling. They don't believe you. What they want to invest in is a company culture. They want to be a part of something. They want a job done right. And they're correct. That is what a rational actor would do. And I think that maybe what's most advantageous about today is, I think that there's a lot more open discourse. I think people can say what they think in public, on social media in particular. There's the ability to just come out and say what you believe. If you think someone's doing something unethical, it's very easy, even anonymously, to just come out and say it, and people will find that message, and it will affect their decision-making process. So, you know, there's a big debate right now about the Red Sea, because there's still a lot of owners who are cashing in on those premiums. And, you know, a seafarer was killed the other day, and they couldn't even fetch his body out of the engine room. And what's his family going to get? Maybe 50 to 100 grand? And the owner's going to get the worth of the entire $37 million Kamsarmax.
Well,
So
I will say it's been my experience, and I've been around the shipping industry for many years. Ship owners, by and large, are extremely focused on the seafarers and the safety of their personnel, both at sea and on shore. And I know that many people in the room here had a lot of trying times when the Ukraine war broke out. And I can't tell you the number of people that, just in speaking with them and reading about it, were trying very, very hard to secure the safety of their seafarers and their families during that time.
Right, and I don't want to take away from that and paint with a broad brush, but I think what I'm trying to communicate is that there is a spectrum, and that spectrum includes nuance. This is not a binary decision, and there are management teams who spend a lot of time not just communicating, because it's not just communicating, it's actually caring and thinking about it and designing a policy which will be recognized. And there are others who would chuckle at these ideas. They would find this discussion incredibly naive. And I've heard those conversations. I was in a bar last year, exactly a year ago here at Marine Money, and I heard a couple of executives, they didn't know I was there, and they were discussing capital allocation and the cynicism with which they discussed it. And this is a company which has a fairly good reputation. It does trade at a discount, but it has a fairly good reputation. And yeah, that to me was life-changing. Because then you can no longer expect people to just do what would be logical. It's too naive.
Let's switch topics a little bit, because I was very interested when we discussed this, you know, a while back, and in the recent panels, there seems to be a growing focus on activism, either in, you know, investor activism. Now, we've seen a lot of examples of that over time, both not just from the standard, you know, investing community, maybe the fund community, but also from within the shipping industry itself. So there are a couple of notable examples of that. We heard a little bit about the Genco situation, which is, you know, there's been recent news with respect to, and also there's been some coverage in Trade Winds and some of the other periodicals about some of George Economou's, you know, approaches toward several companies, particularly those that are managed out of Greece. And I was wondering if we had any insight into what's going on in the activist community and why shipping is or is not a good target for activist investing. And maybe Ned can kick us off on that one.
In my private equity company, I've always been a partner with management, so I'm not prone to criticizing publicly or being an activist. And when I got involved in shipping, I also, with the private equity bent, tried to take significant positions in a few companies, get to know the management, visit with them, and in most cases, the management did visit with me, and I am opinionated. I don't think any businessman is strong in all aspects of everything, And in our companies in private equity, we pretty much always helped run the value creation finance part, and the other guys who owned the company and ran it for years were in charge of operations. And I took that approach, and I think even in some of the companies where I have a significant position, I am talking to the management, and they're maybe listening. I know Paul is sometimes skeptical that they might even be listening, but I do think I've influenced them. And then in one company, which I just heard I'm allied with by Ted, I'm not disgruntled, and I'm one of 3 major shareholders who likes its going forward strategy and path. That's not the case, and I started writing about it. I have, it's my biggest percentage gainer, and I hate it. But basically, maybe some of the things that I've written about are sort of getting listened to. I don't know.
So I guess, Paul, maybe you can address that a little bit. And when do you really get activist, hostile, rattle the cage?
Well, I think the activist depends on what they're seeking to achieve. I think, unfortunately, for the most part, look, what George Economou did was greenmail.
Greenmail.
Right? And that's different, right? I think, for an activist to come into one of these companies and seek to change the DNA or change the way they're operating, honestly, they probably picked the wrong company to begin with. When we dealt with this stuff at Eagle, and we woke up one morning and had these 2 large shareholders, the problem is neither of them wanted to buy the company, right? All they wanted to do was get enough control of the company to effectively have control over a public company to continue to do what they did with other companies that they controlled, right? So, I think that I don't view that as activism. I think if you have something to say, like in the case of Disney or something like that, and you want to change the direction or try to force some change, that's fine. But I also think you need to be careful about people who just try to, people who are placating you, right? Throwing a director onto a board doesn't do a damn thing, right? It just doesn't. I will tell you that with board dynamics, it's easy enough just to deal with that. You bring them on the board, and that's fine. And frankly, they're now within the confines of the board and the confidentiality of the board, and you're sort of screwed. I think if you really feel like a company is undervalued and there's an opportunity, then buy the company. That was my advice to John Custis. You have $1 billion, buy the company if that's what you really want to do. I think I would also say that another sign that something's probably not right is when the principal takes the investment on a personal basis, finds out the life is going to be harder than they thought, and then sells it to the public company in order to deal with the risk of the process going forward. Those aren't good signs, and I don't think that to me isn't an activist, right? That is somebody who's just trying to be disruptive, to try and bring the stock down and try and accomplish what their goal is to get control. But I think activism is fine if you really have a message and people aren't listening. But I think the reality is, to Ned's point, most of the good companies out there, most of the people you want to align yourself with, they will listen. And frankly, they've probably thought about it, and they can have a discussion with you about the issues.
Yeah, thank you, Paul. I really appreciate what you said at the start of that about the green mail, so thank you. I know we went back and forth on NAV, but we're fully aligned on that viewpoint. I think Ed might have mentioned it actually last year on the closing panel, so I don't want to steal all his ideas and views, and hopefully be a good segue over to Ed's thoughts on this topic. But I think he used the word suggestivist last year at the conference. Hopefully I'm not misquoting you. But that's been sort of an approach that we've taken over the years. And there's been a lot of companies that, again, NAV is just a starting point, just a screening metric. But there's a lot of companies that have traded very cheap, very attractive, and have produced enormous returns and significantly outperformed their relative companies, whether or not they were stalwarts like some of the Frederickson Group companies like Flex or Avance Gas, or whether or not they were lesser known or newer entrants like Ocanis. One of the ones that we had a good dialogue with and worked out extremely well over the last 6 years now, was Dorian LPG, was another huge success story. And, that's, sort of a family-backed firm, right? And now they're one of the highest valued stocks in the entire shipping universe, right? And because they've done the right things and they've made some changes, we approached them about doing a big repurchase offer and pushed them behind the scenes for that for months. And there was a prominent shareholder at the time who hopefully is maybe not in the room so he's not too offended, but he actually wrote a piece in TradeWinds, an opinion piece, saying do not repurchase shares at 40% NAV at cycle lows. It blew my mind. But thankfully, Ted and John were forward-thinking and took a little risk, and they did one of the best tender offers perhaps in the modern history of shipping. Ted referenced it earlier. They bought shares, I think it was $13.50, and they've already paid out that much, almost that much in dividends since the tender offer, and we're getting in the 40s and 50s ranges. So phenomenal stuff, and that falls into the sort of suggestivist camp, and I think we've had a ton of success over the last few years with that.
Yeah, and I think one major suggestion, which I don't know if you're going to go over, is it'd be very nice if some companies didn't put in impossible anti-takeover defenses, and they trade at values that are grossly undervalued, probably somewhat because of that. But that's been one of my goals.
That's a classic entrenched management situation that
has
always been the bane of the investor community for many, many years, not just in shipping, but across many different sectors. So Ed, I don't know if you have any thoughts on activism.
Well, just very quickly, I would say that there's various ways to get the message across. And I remember reading Ned's letters to Navios, which were very meticulous and well thought through. And I remember reading my expectation of whether management would be listening to it or caring. And I remember imagining kind of the disconnect between the thought and care that went into that letter and well, I'll have to be careful with my choice of words, but the lack of thought and care for minority shareholders, which are demonstrated by the actions of the principal. But I would just say very quickly that there are other ways to be activist, and one of my favorite ways is to post a photo of the person who is the offender on Twitter and put a derogatory message about them, something as offensive as possible, which you'll be sure everyone will see, including their employees and their family, which gets to the heart of what they've done wrong. So often in response to a second tweet, I'll post a screenshot of the SEC filing with highlighted, whether it's they've issued shares in a way which is not accretive, or they've given themselves 6% of the company overnight via share-based compensation. And I find that it's a little bit of a different approach. It's more inflammatory. It's definitely more offensive. I think that one shipping company who I saw earlier this week, I said that he had the most punchable face in shipping. And because he always has this smug grin and he's just screwing his shareholders over the whole time. And that gets attention. And I'm not saying it's going to work, but at least he gets punished for what he's doing. Because otherwise, the real problem is, as minority shareholders, we don't have leverage over these people. We are not John Fredericksons of each company.
With just a short amount of time left, perhaps we can go up the line here. A few short words on what you think a public company can do to be a better steward of the public's money in today's environment. Just a couple of words. Why don't we start with Paul and come down the line?
I think it's pretty simple. I think that you have to align yourself with the shareholders, and that'd be the common shareholders, and make sure that the actions you're taking, the things you're doing, are in their interest and not in the interest of management of the board, and that this isn't you're not trying to create an opportunity or a job for life.
Ned?
Yeah, I would say the same thing. You should be open-minded to shareholders, and you should be aligned with your shareholders so that if you make money, they make money, and we're all rowing in the same direction.
Jay?
I think the number one step that every company can do, no matter what their corporate governance is improve their communication and accessibility. In the Air Force, we have a saying of our weapons officers, humble, approachable, credible. And I think the executives who bear and live that mantra of humble, approachable, credible, will do well for their companies. And the only final point is I totally agree that in the ideal world, every company is like Eagle Bulk, right? They're willing to do the right thing for the shareholders. They're not looking for jobs for life. I applaud Gary Vogel. I'm very happy with the deals that went down there. But the reality is not every company is structured like that. But I don't think that's incompatible. I think we can have family companies. We can have, not that I love them, the related party structures, but there can be companies that have some related party structures, have a family dynasty backing, and can still do extremely well.
If I hold a share that's not really for sale, what's it worth?
It can be worth a lot over time if the family manages it effectively. It can be worth a lot.
Ed, 10 seconds.
Yeah, well, there's a joke I often tell, which is what's the best way to become a ship owner, and that is to be born to parents who are ship owners. And I think that over time that will just erode, and that we're going to have stewards of capital who are rewarded for their actions. And so none of this will matter because over time that's the trend which is already happening for the last few decades, and we'll be fine.
Well, I'd like to thank all of you. That was a fantastic discussion. And thank you to the Marine Money team. And wish you all good luck.